Hey everybody, welcome to your mortgage market weekend review for the week of January 23rd, 2023. And oh, what a week it was. We started off Monday with MBS 5.5s being off 23 basis points. Supply was the name of the game so far in the morning. Bonds drifting weaker in the overnight session as European supply pushed EU yields higher. In the first hour of domestic trading, a slew of new corporate bond announcements was putting upward pressure on yields domestically. The index of U.S. leading economic indicators declined again in December, following a decline in November. The U.S. LEI fell sharply again in December, continuing to signal recession in the U.S. economy in the near term. Overall economic activity is likely to turn negative in the coming quarters before picking up again in the final quarter of 2023. Basically, the labor market and consumption are the only things holding up the economy at this moment. Fed funds futures are a lock for a 25 basis point hike next week. 25 basis point hike would put Fed funds at a target rate of 4.5 to 4.75, and the March futures see another 25 basis point hike, putting it in around 5. The May and June foresee a 33% chance of another 25 basis points. The street estimate for quarter 4 GDP is 2.7%, which is pretty robust, but the Atlanta Fed GDP now estimate is for 3.5. Both seem very high given all the things going on in the economy, and the ISM numbers showing contraction in manufacturing and services. Maybe some of this is inventory build, which will have an effect of borrowing growth from quarter 1. There's also a lot of news going around about the new LLPA matrices coming out. So here is a pretty cool chart that was done by Chris Maloney over at Bank of Oklahoma, or at least was reported by him. This shows the changes. So it's the change in the LLPA grids for purchases. So this shows that basically lower FICO scores, higher LTVs are going to get much better. The hits for those lower FICO scores and higher LTVs are going to lessen, while higher FICOs and lower LTVs, so people that have more money, are going to be subsidizing those to help get people with lower credit scores and less money down into mortgages. Also, cash out grid is basically, this shows the changes for cash outs. So basically, cash outs are going to get a little bit cheaper for higher credit borrowers. So it goes the opposite direction for cash outs. Bonds responded to the glut of corporate issuance this morning. Higher oil prices and looming treasury auction cycle may have added to defensive strategies. Trading was also light. So at the end of the day, we were down 11 basis points, which puts us in at 101.23, which is just above that technical indicator of the 25-day moving average of 101.081, with a ceiling of 101.671, though we do have a convergence of 3 extra floors right below that line, so should be huge drops. Also heard for the second time, I don't have a source for this, but I've heard it said now 2 or 3 times that about 40% of loan officers have not renewed their license this year. So less people competing for business, go out and get those loans. I also got a post from our sponsor at WellThatMakesSense.com. So it's Monday Morning Influence with Jocko Willink. So Jocko Willink is a great author. He also trained and led a whole bunch of Navy SEALs. And he said, fight weak emotions with the power of logic. Fight the weakness of logic, the power of emotion, and the balance of the two will find strength and tenacity to stay yourself